Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a true oil and natural gas expert. He's been writing a paid oil and natural gas newsletter that has been successful with stock picks for over 20 years now. This is all he covers, and he is very good at it, along with my former boss and his current business partner, Roger Conrad. He runs the Energy and Income Advisor. Elliott Gue, thank you for joining me again.
Oh, thanks for having me on the show.
Now, Elliot, we're recording this interview on Monday, February 3rd, 2025. The West Texas Intermediate crude oil price has corrected a little bit in the last week or so. It was getting into kind of like $77, $78 a barrel. It's down to like 73. It's been kind of range bound for the last 8 to 10 months. I want to get your thoughts if you think the oil price will stay in a trading range given the recession risks and Trump wants to drill, baby, drill.
Yeah, I think that oil doesn't have a lot of downside from current levels. I think you're more likely to see $85 or $90 a barrel oil at some point in 2025 than you are to see, prices significantly under 70 for any length of time. I think generally the market has gotten the Trump policy towards energy wrong. The phrase drill, baby, drill, a lot of people think that means that these U.S. shale producers are going to be flooding the market with a lot more supply. But the reality of the industry is that investors in energy stocks, what they want is free cash flow. And what they really want is dividends and buybacks, debt reduction, any other shareholder friendly moves. And any company that deviates from that plan, any company that's seen as boosting capital spending to grow production, the stock is immediately slaughtered. So the way it works nowadays, there was a time, back in the pre-2014 era, say from 2010 to 2014, 2015, where shale companies were valued based on their ability to grow production. The early days of the shale boom, the idea was companies that show the fastest growth in production, barrels out of the ground, got the highest stock valuations. But since the bust in 2014, that's not been the case. Companies that spend too much capital and are become capital inefficient just to grow production, even at low commodity prices, I mean, these stocks are absolutely slaughtered for that. And so the calculus has become more about targeting free cash flow and targeting your drilling activity based on prevailing commodity prices. So any company, look at any major U.S. shale company, a name like a Diamondback in the Permian, right? Any of the independents, and look at their quarterly statements, and you'll see that they have certain costs, right? Lease operating expenses. They have capital spending, of course, which is really the cost of drilling and mainly the cost of drilling and completing new wells. You have obviously general and administrative costs and all the things that we're used to in other industries as well. And you add all that up and you come up with what their break-even cost is, per barrel of oil equivalent that they produce. And the way they set their capital spending is they say, okay, this is how much it costs us at this current level of CapEx, right? If we increase our capital spending, we can produce more, but it'll also push up our break-even cost per barrel. And so there's a cost benefit calculation there, right? There is, how much free cash flow can we generate at this level of activity and this oil price? How much free cash flow can we generate at a higher level of activity given a higher oil price? And so my point is, it's a simple economic choice. And no shale company in the world, in the US, right, is going to increase capital spending unless prices are high enough to justify that. At $70 or $75 a barrel West Texas Intermediate crude oil, they're not going to increase their drilling activity. They're not going to increase their production. And it's not because they can't, because they're being, there's some regulation in place saying you're not allowed to do that. It's because they don't want to at current oil prices. At $90 a barrel crude, it's a different story altogether. They can make, more money by spending a little bit more capital, increasing their production a little bit to take advantage of that higher commodity price environment. But, the U.S. does not operate a socialist energy sector. It's not controlled by the government. That's obviously not true in a lot of countries. You've got places like Saudi Arabia, Brazil, where the government is either owns outright the national oil company or is a major, stakeholder in the company, can order the national oil company to increase or decrease production. That's not the case in the United States, which is one of the reasons why, we're the largest, I think a major reason why we're the largest oil producer in the world. You have a lot of companies out there trying to design new technologies, develop new methodologies for producing oil more efficiently. And so they've done that over the years. The whole shale boom is because of innovation on these part of these companies. Without the government meddling or encouraging this or discouraging that. And I don't think that's going to change because of, drill baby drill. They're still going to look at
So it's marketing then. It's just marketing then for votes then, because you're saying that the capital allocation for, say, an ExxonMobil, and there's been what, 250 billion, give or take, of acquisitions the last 2 years.
yes,
ExxonMobil goes and buys what, Pioneer, one of the
yes,
largest Permian Basin plays, and what, for 60 billion, give or take. And then they didn't increase production. What they, I think, or production is flat. And then they said they might even cut production soon.
yeah, they're going to make that decision based on, again, the price of oil and how much free cash flow they can generate. Other producers, you'll hear they'll talk about increasing their production, but they're talking in terms of barrels of oil equivalent, and a lot of that has to do with, gas volumes and natural gas liquids volumes that are produced, ancillary to their oil production. As in its entirety, the U.S. oil industry is not increasing production right now. There's a fallacy out there that that's not the case. But if you look at the last 12 to 18 months, U.S. oil production is flat to slightly down. And the reason that it's plateauing here is because these producers don't want to produce more oil into the current commodity price environment. We've had low natural gas prices, low oil prices. Nobody in their right mind in a capitalist system that is trying to maximize shareholder value and make their stock price go up, let's face it, right? They're not going to increase production into a low commodity price environment. That's just not going to happen. It's not happened for years since the early days of the shale boom, middle years of the shale boom, when everybody was going crazy over growth. Now, there is part of the Trump energy policy, drill baby drill, if you will, that is for real, and that is, there have been, under the Biden administration, we had a number of attempts to sort of throw a wrench in the works, right? We had, when Biden first came into power, we had a pause on federal drilling permits that was ultimately struck down by the courts. We had this pause on new liquefied natural gas permitting, right? And that was about a little over a year ago. And of course, those have been rescinded under President Trump. Generally speaking, I think that the risk of, for example, some sort of major climate legislation that would permanently hamper the profitability of the industry is much lower under a Trump administration that would have been under, a Biden or Harris administration, right? So the government can certainly do things to remove red tape, to make it easier for the industry, just to not target the industry with anti-fossil fuel legislation. So you can remove red tape, you can remove excess regulation, you can remove excess regulation on things like building infrastructure to, for example, export natural gas or export oil or products. But you can't. But drill baby drill can mean good things for the industry. It can mean making it more investable for large investors who aren't going to be as worried about things like net zero or environmental factors in their investing process. But it's more subtle change than the idea that Donald Trump comes into the presidency and therefore you're immediately going to have an increase in oil and gas production. I mean, that's just not how it works.
Yeah, I
It's
agree.
just a more subtle.
Well, I think what will benefit, and we'll talk about this later in the interview, are like natural gas pipelines,
Yes,
infrastructure, getting the oil and natural gas, the NGLs to the refineries, and then liquefied natural gas export facility, either maybe some type of discounted loans, or at least the permitting process won't be as cumbersome, where it takes many, many years to
right.
get a liquefied natural gas export facility approved through the permitting process.
I agree with all that. I would just say, it's a more subtle tailwind than an immediate attempt to increase production across the board, which again, I mean, if oil prices go to, and that is useful because, if you think about it, if oil prices, say there's something happened and tomorrow oil prices were at 90 or $100 a barrel, it would be much easier under a Trump administration, I would say, likely, for US producers to increase production relatively quickly to alleviate that risk than it would have been under a Biden administration or a Harris administration. But it's a very different thing to saying, oh, this is going to mean immediately a big increase in US oil production
Well, I
because it
would
won't.
say you're one of the few energy experts out there that's actually kind of bullish on the oil price in the short term, because a lot of the oil and energy experts I see on business TV or on these other podcasts, I mean, a lot of them expect like global recession. If there is drill baby drill, it could flood the market with extra supply that the global economy cannot take, and they've been predicting that the oil price could get to $60 a barrel or lower. But I think in that there's been a lot of experts like Rory Johnson and some of the other Paul Sankey, some of the others that have been repeating this for months now. But I think in that scenario, if the oil price, Elliot, gets to, I don't know, 65, I probably won't even get to there. But if it gets close to there, I would suspect the Saudis and OPEC will start to cut production further because they don't want the oil price going below break even cost.
Right. Yeah. I mean, I think that, there was a narrative maybe last September, October. There was an article in the Financial Times. I think there was one in Bloomberg. There was this narrative out there that Saudi Arabia and the rest of OPEC, the OPEC plus cartel, but mainly Saudi Arabia, were going to flood the market with crude into early 2025. And the market was going to be massively oversupplied, and you were going to have this collapse in oil prices. And what we said all along was that the Saudis aren't going to do that. And I think a lot of people are hearkening back to what happened back in 2014. And back in 2014, I mean, just go back there and look at it. At the time that OPEC decided, they met in late November 2014, I believe, and they adopted this sort of pump at will strategy. Okay. And the idea was they flooded the market with oil. They'd been artificially propping up the price of oil to around $100 a barrel for years, right? From 2011 all the way up through most of 2014. Oil prices are around $100 a barrel. And the Saudis and the other Gulf states were limiting their own production to keep the price of oil high. And by keeping the price of oil around $100 a barrel, they were encouraging all this new supply from the United States. So at that time, U.S. shale production was growing at something like a million and a half barrels a day every single year. And so the Saudis finally said in 2014, there's the head of the Saudi energy ministry at the time. It was this guy named Ali Al Naimi. He actually wrote a book uh, some years ago, and he tells you exactly why they made this choice. They saw that every time they cut production a little bit, you had these US shale producers increasing their production and kind of filling that gap. And so they were just going to continue to lose market share, artificially piping up the price of oil, and the US producers were just going to fill the breach. And so they decided to push out more oil, which drove down the price and ended the extreme growth we saw in US shale production. And it also forced the shale producers to merge, to become a lot more efficient, all those things that we've seen since then, the last 10 years. But now is very different than what we saw in 2014. Going into late last year, US oil production, as I said, was flat for 12 to 18 months. Look at the Department of Energy numbers and include their adjustment factor, which is their supply adjustment factor, and you'll see that on that basis, it was flat to slightly even down. And so, what's the point? OPEC and Saudi Arabia, the only reason to allow the price of oil, obviously, they don't want the price of oil to fall to $40 or $50 a barrel. The only reason that they would allow that to happen is if they thought that that was going to protect their market share. In other words, if you have very rapid growth from higher cost producers, by cutting the price of oil, by pushing out more of their own production, cutting the price of oil, they can squeeze those higher cost producers out of the market. But that's not the situation we have now. Right now, we have, U.S. producers are at best flat production. If the price of oil goes down a little bit more, I would say to that $65 or $70 zone and stays there, you're going to see falling production out of the U.S., potentially quite rapid fall in production, because they can't generate that much free cash flow at that price. They would rather leave the oil in the ground and produce it, a year from now or 2 years from now when prices are more favorable. And so, and the Saudis would obviously lose revenue with no increase in their market share. So the whole narrative doesn't make sense.
Well,
in my mind,
for recap of 2014, I mean, the Saudis ran at large losses. So while they were regaining the market share, they put like a lot of the U.S. shale oil producers out of business, right? When they decided they weren't going to keep oil prices around 100, right? And they increased production. And then they ran at losses for a long time. But that's not sustainable for them either, especially in an environment now where there's been a lot of inflation the last 5 years.
Yeah, no, it's not sustainable for them over the long term for sure. I think they could do it if they wanted to for a period of time. But, as I said, I don't think there's a major reason to do that. The only reason that the Saudis, the only time they've flooded the market with oil, there's been 2 times in their history that they've done that. The first time was in 1986, and the second time was in 2014. And in both occasions, it was for exactly the same reason. In 1986, they saw that they were cutting their own production, and U.S. producers from the North Sea of the U.K. and Norway, Mexico, other non-OPEC countries were increasing their production. So they were losing market share by artificially propping up the price of oil. So they flooded the market, price of oil collapsed, it squeezed a lot of these higher cost producers, and over time, supply and demand balanced. They did it again in 2014. Now they don't face that situation. If you look at the IEA estimates, the International Energy Agency estimates, most of the expected production growth outside OPEC, the most of the expected production growth is supposed to come from the United States, which is pure fantasy because they're talking about 600,000 or 700,000 barrel a day production growth out of the U.S. and U.S. production growth is flat. So that's nonsensical. Mm-hmm. You've got a little bit from Canada. Canada is in the same position we are. They'll produce more if the price is high enough to justify it. And then you have, Guyana in South America. That makes sense because, Exxon has a project that's been ongoing for some time. They're opening up in stages. There is probably some production growth from them. Brazil, you have a little production growth. And then all the rest of OPEC, besides those 4 countries I just mentioned, the United States, Canada, Guyana, and Brazil, they're expecting us to get another 600,000 barrels a day of growth out of those countries this year. And those other countries haven't grown production in literally 20 years by a significant amount, certainly nothing close to 600,000 barrels a day. So the idea in my mind that we're going to see this massive non-OPEC production growth in 2025 and that OPEC is going to flood the market with barrels to push the price down, it's both pure fantasy. I think more likely what you're going to see is a lot of these forecasters are out there saying, oh, global oil inventories are going to swell in Q1 and Q2 of this year. And I think more likely you're going to see flat to down inventories. And at some point this year, I think it's going to dawn on markets that these narratives are not based in reality. You have speculative positioning in the oil market is actually very, very low. It's bearish. I think you could see significant upside in oil prices at some point this year when it becomes clear that the supply-demand balance is a lot tighter than most people think it is. And a lot of these experts out there who've been predicting, lower oil prices, as you said. I mean, a lot of them have been predicting that for some time, and the oil market supply-demand balance has remained a lot tighter than almost anyone thought it would. I'm in the camp.
Let me add some points that I think that the Saudis, if there is some weakness in the oil price, say below 70 a barrel, and you think that it won't go below 70, I think it could briefly. I think the Saudis will announce production cuts or extend the current production quota, or they may cut production even more. The other part of the market, I think no one's talking about. I think Trump, I think a Republican controlled Congress, I think they will be far more receptive, especially with the energy secretary Trump has, and Trump's been talking about national security. I think he want to actually start buying and refill the strategic petroleum reserve because it was just all lip service under the Biden administration the last year and a half. They didn't really buy very much. I think we need to go and buy stockpile that oil.
Yeah, I do think that's a distinct possibility. I mean, just a couple of things about the Trump administration. First of all, the Biden administration, if you remember, few years ago, late 2022, oil prices were very high. There was this idea out there that the Biden administration was going to start trading oil, right? They were going to sell oil out of the Strategic Petroleum Reserve to push down prices, and then when prices got low, right, they were going to buy it back to refill the reserve. And of course, they sold all that oil to artificially depress the price of oil conveniently right around the midterm elections, mind you, right?
November
And
2023.
right, it was late 2022 that they started selling. It was 2022 they started selling en masse oil, and you had the midterm elections in late 2022, and right around then you had oil prices going down. And it was because of all this oil. They were selling at one point 1.5 million barrels a day out of the U.S. Strategic Petroleum Reserve. So the Strategic Petroleum Reserve is back down to the same levels as the early 1980s. So Reagan was president the last time we had this little oil in the Strategic Petroleum Reserve. And that was right after we created it, by the way.
And the U.S. population now is what, 80 million more people than back then?
Yeah.
And
Yeah, I mean, it's well over 300 million, at least by their counts, right? So you have this Strategic Petroleum Reserve has basically been drained. And then the idea was, though, and they kept telling us that they're going to start buying back oil when prices get under, I think it was $70 a barrel. But there was one point where the entire futures curve, looking out 2 or 3 years, was under $70 a barrel, and they still weren't buying oil. So it's clear that that was just an effort to push down the price of oil, and there was very little intention to then buy back the oil to refill the SPR. Yes, I think you might see that under Trump. And hopefully, the government will get out of the business of trying to trade oil because, they're not very good at it, right? As you might expect.
Well, it was done for political. It wasn't done for profit onto the market. It was done for political purposes. You're saying, right, to try to influence an election, to try to reduce inflation before the November 2022 midterm congressional election. So they didn't sell the oil for a profit. They sold it to try to help them buy votes.
Yeah, they sold it to push down the price of oil. And then the idea was, and if you go back and you look at it that time, you had a lot of these commentators saying, oh, well, they're going to be trading oil. They're going to sell it when it's expensive, push down the price of oil. And then when it's cheap, they're going to buy it back and refill it so they can do it again. So,
they're hedge fund traders now.
Yeah, there was this idea that they figured out a new way of managing oil prices, a new thing the government can do. But they're not very good at it. First of all, when you're trading, it's generally not a good idea to tell everyone what you're going to do before you do it, right? If you're the largest trader in a market or one of them, and you tell everyone you're going to start buying something when it gets to a certain price, obviously everybody's going to front run you on that.
Yep.
So there's a lot of problems with the government trading oil. And, I agree with you. Hopefully they will refill it at least gradually over time when prices are low. The other thing I would mention, Chris Wright, who is the DOE, who's going to be the DOE nominee,
Secretary of Energy, yeah.
Secretary of Energy, obviously he ran a company called Liberty, which is a fracturing company. So he knows the shale business inside and out, which is, I think, a welcome development because obviously you'd rather have an industry insider, a fossil fuel industry insider, because we still get well more than 80% of our energy here in the United States, like everywhere else in the world, from fossil fuels. So, having somebody who understands the industry, I think is a good development. He can help advise the president, which is his role, right, on energy policy, what it means for the industry. He can act as a go-between. Having a person who actually understands the business is a positive development. But I would say that if you go back to 2020 and we had the commodity price collapse, Donald Trump was president of the United States, obviously then, and you had him actually talking to the U.S. energy companies, uh, had him talking to the Saudis, right? About the low price of oil being a problem. I mean, he understood at the time that having a very, very low price of oil, very depressed commodity prices, is ultimately bad for the United States because if you bankrupt your entire energy industry or put them too far on the back foot, then they're not going to be there to supply when the economy recovers. So I do think that he, as a businessman, understands everything that we're talking about. He understands that um, having the price of oil at $45 or $50 a barrel is not desirable longer term because you hurt the industry that you're relying upon to supply literally most of your energy in the United States. I mean, because we produce most of our energy here in the United States domestically. We don't import as much as we used to. And so, yeah, I think that this is all we're talking about is positive. I don't think that it means we're going to see this immediate increase in oil production or gas production, but it is positive for the industry, more broadly.
And the new Secretary of Energy, I mean, I've seen one of his presentations. This was before Trump nominated him, and he was talking about a global energy crisis over the next 10, 15, 20 years. And basically, he said that we shouldn't block or pick and choose winners for one or two specific forms of energy. He basically said that we need to invest across the board, that we shouldn't block any form of energy. So he said we have to have natural gas as a transition fuel. We need to be more efficient with investments in nuclear power. We need to continue with innovations in solar and wind, but none of those forms of energy should be blocked. I think that's a very important point, that we need to invest across the board, that, prior administrations for decades now here in Washington, D.C. and in the European Union, they have not adhered to this. They pick and choose winners and losers depending upon the legislature or Congress at a whim. What with a George W. Bush or Dick Cheney, they subsidized corn ethanol. With Obama, he subsidized wind and solar, biofuels, electric vehicles. A lot of those ones failed. The newest one today, Elliot, there was a solar farm in the Mojave Desert in California. It was projected to last for 30 years. And here we are 11 years later that it was funded, I think, in Obama's first term. And it's already, they're going to shut it down. So the ESG, the energy spending graph, it was promised that this solar farm was going to be great. It was going to last 30 years. It lasted 11 years, and now it needs to be scrapped.
Right. No, exactly. And one of the themes that we've said for years is that the world and the United States and the world generally, you need to have an all of the above energy policy, right? You have to pursue multiple technologies because you don't want to get. I mean, energy is the lifeblood of the economy. I know it's only it's less than 5% of the S&P 500, but the reality is that as we're learning, right, with the talk
Artificial
of
intelligence, yeah, all the tech, yeah,
all the tech depends upon energy. So too, industrial. You can't build cars. You can't have just ask Germany. You can't have a manufacturing sector, no matter what you've done historically, if you don't have access to um, reasonably priced energy that is relatively reliable in terms of supply. Things start breaking and going down. And that's what we've seen in Europe. And so, the idea is not to have all of your gas come from one supplier, all of your oil come from one supplier, or in fact, to rely solely on natural gas, solely on oil, solely on nuclear. You want to have a mix of those technologies so that no matter what happens, you have some way you can pivot to, maintain reasonably cost energy supply. And so, I've seen some of his presentations in the past at various events and whatnot. And Chris Wright, I'm talking about now. I mean, and that's definitely been, as you said, his mantra. And I think the idea that has been out there at times that we don't need any more oil, we don't need any more natural gas. It's all going to be replaced. It's just wrong. If you look at it, 20 years ago, the world got something like 85% of its energy from oil, natural gas, and coal. The most recent data that I've seen, which I think is for 2023, was 81.5% from coal, oil, and natural gas. So those three fuels over the last 20 plus years since 2000, we've actually seen only a few percentage points of the global energy pie shift out of those three fuels. And, look at China, or more importantly, look at India. Look at the amount of energy growth coming out of a country like India. You have over 1 billion people rapidly industrializing, growing at a much faster pace than the Chinese economy. Obviously, they're using more oil, natural gas, and coal. And, they're building new coal plants. They're negotiating with Russia, right, to get cheaper oil, which totally makes sense for them. And, I think that every country is going to need, more fossil fuels. And I mean, it's just the reality of it. And to say anything different, you're just kidding yourself. And, it's ultimately harmful because producing more energy, producing more fossil fuels is a function of capital spending. It's a function of investment. And, if companies are being discouraged from investing in new sources of natural gas, new sources of oil, then, you're not going to have the supply, and you're going to have, inflation, commodity price inflation. I mean, it's just basic economics.
Or your manufacturing or industry could shut down because energy costs spike too much, or there's no electricity, no reliable energy for electricity generation, or your small businesses get hammered with an extra $1,000 a month electricity bill, which a lot of small businesses really can't handle cost increases that much. We saw this in Europe and European Union and Germany because they were overly reliant on Russian natural gas, or they were banning fossil fuels with those policies. They were saying we're going to phase out all fossil fuels, all coal, all natural gas, and switch to wind and solar. Well, we've seen with Europe since from 2020 to the last up until recently that a lot of their policies have really put their economy behind the eight ball there, not very efficient at all. And now I think with Trump in the White House, Republican-controlled Congress, there's going to be a concerted effort to approve more liquefied natural gas export projects. And I think a lot of these European Union countries will want to buy natural gas from the U.S., number one, to diversify supply of natural gas away from Russia, and number two, also to appease Trump.
Absolutely. I think both of those are going to be motivations. And, I mean, obviously, I think, most of your European countries would rather buy natural gas from the United States than many other sources, right, out there.
Especially Putin, yeah, because Putin could just turn off the taps or say, oh, we want to renegotiate the price.
Right. And, that's why you don't want to have a single supplier, especially a single supplier that you don't necessarily get along with well politically, right, as your only supplier of a very important, commodity. And I look at countries like Germany, like the United Kingdom, which is a particularly sad one to me because the United Kingdom actually could have produced more gas out of the North Sea if they had not really just deliberately put up headwinds for the energy industry within the United Kingdom. They could have produced more natural gas. They wouldn't be in the situation they're in now, one of the highest industrial energy costs in the world. And, I think a lot of people think, oh, electricity, it's about the consumer. It's about the consumer's electricity bill. But, the real rub there is not so much the individual consumer, but the cost of electricity, cost of power for industry. If the cost of power goes up too much, suddenly a lot of your industries start shutting down. Example, fertilizer, right? Most nitrogen fertilizer is synthesized from natural gas. You can use coal as an alternative. Obviously, that's not very popular in most places. But if the price of natural gas goes up, you shut your too much. Your fertilizer producers have to shut down, and you can't even feed yourself, right? Because all these crops require nitrogen fertilizer. So it's a shame, and a lot of these countries have really done it to themselves to a great extent. But where we are now, I do think it presents an opportunity for U.S. energy producers.
Yeah, and if you're an emerging market like Sri Lanka, you don't have all those U.S. dollars stockpiled with trade surpluses they switched their fertilizer, I think, to organic fertilizer that was non-fossil fuels from the NGOs and the ESG crowd. And then they had crop shortages. They didn't have the dollars to go import the food, and the government was overthrown. So obviously,
Right.
I don't think that's necessarily going to happen in a country like Germany or something that ban fossil fuels. They'll have to pay more for their food imports if there's crop shortages. But like for an emerging market, that could be dire. That could be like regime change and like total overthrow of the government.
Right, exactly. And that's a perfect example of what happens when, you make a move. Um, you, some seemingly interesting moves can turn out to blow up in your face. If you try to shift away from fossil fuels too quickly, you end up, with problems. And we've seen it everywhere. And I'm not saying, as we talked about, I'm a believer in the all of the above thing. I'm not saying you shouldn't invest in solar, wind, other sources of energy storage, for example. But the idea that you can shift entirely to those energy sources in a time frame like 5 years or 10 years or 20 years, it's just not borne out by the actual facts of countries that have tried to do that.
Well, I also
Um,
think that current data centers are such energy hogs, and the next generation data centers, like the Colossus one that XEI built, Elon Musk's artificial intelligence company built in 120 days, that has 100,000 NVIDIA Blackwell GPUs there. So, I mean, that's like a record size. That is a super energy hog compared to the current data centers. So, if the industry, all the big tech companies are going to start building data centers of that size or larger, I mean, we're going to need we're going to need an across the board approach. We can put solar panels around the data center on the roof or around the data center. We will need natural gas pipelines into the data center, potentially nuclear power. Potentially, we're going to need all these things at the data center for all the power because they're such energy hogs just for the electricity and the cooling systems and all that stuff.
yeah, and the other thing about data center, you can't, you have to have reliable power that's always available. You can't have intermittent power sources. You can't be overly reliant on, an unreliable grid, for example, that's subject to brownouts or blackouts. You need a baseload source of power that can feed power reliably to that data center, 24 hours a day, 7 days a week, without interruption. It can
And backup
be
systems. So you have your
and
nuclear
backup
or
systems.
yeah. So you
Yes.
have like natural gas or nuclear. You might even have two or three backup systems there just in case. Because if that goes down, I mean, like everyone's business or all the search functions, all the artificial intelligence algorithms, they could all go down too. So you have to have those things.
So, the only ways we know to do that are using fuels like natural gas or nuclear, probably both backed up, right? But, natural gas to me in the short run is probably the more likely solution because you can permit and build a new natural gas plant in a couple of years. Obviously, for nuclear, it takes a lot longer. Now you're going to see reactor restarts, I think, over time. We're already seeing talk about that, of course, Constellation, their deal with Amazon. But the reality is that building a new nuclear plant, even a small one, is going to take. There's a lot of regulatory red tape to site and build a new nuclear power plant. So I think it'll happen eventually, but it's going to take time. And so in the next few years, I think the probably the number one source for a lot of these electric power plants or a lot of these data centers in terms of electric generation facilities is going to be natural gas. It's a relatively clean burning fossil fuel. It's dependable technology. It can be sited and built and permitted relatively quickly, and the United States, fortunately, has an abundance of it. And as you said, I mean, these data centers are energy hogs. In the 2020s, you're going to see electricity in the United States demand grow at the fastest pace in percentage terms since the 50s and 60s, and that's incredible. Nobody ever thought that U.S. electricity demand was going to grow at the pace it did back then, because back then is when we saw suburbs around major U.S. cities really grow. So people were moving out of the cities
And a
into bigger
population boom.
houses
Yeah,
and a
baby boomers.
population boom. So you had a growing population living in bigger houses outside the city all these new electrical devices, which people didn't have before. Electricity demand grew at an incredible pace. I mean, it was almost like an emerging market level of electricity demand growth. And we're going to see that level of growth, over the next 10 years or so, mainly because of, these data centers. And, meeting that demand growth, it's not going to come solely from solar and wind for sure. And so I think natural gas is going to be a key component of that.
Oh yeah.
Because again, you could slap up a natural gas facility relatively quickly. We're even seeing it, in the Permian Basin. You have, for example, some producers building their own power plants, using natural gas that they're producing to provide the electricity needed for drilling operations. And they build these massive sort of cities out in West Texas powered by natural gas, and that natural gas is coming from their own wells. So you're seeing it in a lot of places, but natural gas is going to be a very important key of enabling all this growth in data centers and electricity demand.
And to add to your points there, on January 28th, you had Chevron announce with one of the subsidiaries of General Electric called Vernova, I think I got that correctly, that they're going to be building up to 4 gigawatts of power. So Genova, the General Electric subsidiary Vernova, is going to provide natural gas turbines, and Chevron will be building the natural gas pipelines and the supply of natural gas enough to power roughly 3 million homes and to data centers in the U.S., Southeast, Midwest, and West regions. So they're already anticipating this. This is not, and I think they're going to have to set up additional natural gas pipelines and supply offtake directly into the Stargate AI facility. I was discussing with you before we started recording that Elon Musk, because with his rival artificial intelligence company xAI, he doesn't get along with Sam Altman of OpenAI anymore, that he should announce a rival project to the Stargate xAI and get Chevron and get Exxon Mobil on board to supply reliable natural gas with pipelines, natural gas supply from the Permian Basin, and then also provide, 10 billion, 20 billion in capital into there, and then get other American companies in there to set that up. So I think that would be smart move from Chevron and ExxonMobil to align themselves with one of these artificial intelligence and big technology data center projects so they have a reliable offtake agreement.
And I think you're already seeing to an extent some of that priced into the gas market. If you look at if you look at the futures curve for natural gas, the front month prices are low. In other words, the price of gas for delivery in March or April or May of this year is lower than the average price of gas for delivery in the same months a year from now or 2 years from now. And so, there one component of that, and I think probably the single most important component of that, is this growth that we're seeing in liquefied natural gas export facilities. So these are facilities that allow us to turn natural gas into a liquid, load it on tanker ships, and ship it around the world to places like Europe and Asia that need more supply. But another component of that is just this steady, grinding, annualized growth in electricity demand and the need to feed all these new generation facilities you're talking about. And, whether it's a captive facility, in other words, Chevron partnering with a data center to build, a natural gas fired facility, which will take supply that would otherwise be dumped on the US market or on the global LNG trade, sort of a captive deal like that, or whether it is natural gas that runs through the grid and serves these power plants. That's a new source of demand for U.S. natural gas, and you're seeing it in the curve, and we've seen it in the curve for some time.
The prices. You're talking about the natural gas curve. I'll talk about the capital. So that those natural gas prices, the demand that you're potentially talking about is relying on the capital expenditure for these technology companies, whether it's Meta, which owns Facebook and Instagram, Amazon, Microsoft, Google, to invest the capital expenditure into the data centers. I mean, Meta already committed, I think they paid for 20 data centers. Their CapEx budget, they just announced earnings, 10 days ago, and they had really good profits. And they said that they're increasing their CapEx budget on data centers is going from 40 billion for 2025 up to 60 to 65 billion. Microsoft said that they might allocate 80 billion this year alone. Amazon has more than that. I saw a Morgan Stanley report. I don't know if it's 100% accurate. It's probably in the high end of the estimates. Morgan Stanley says $300 billion of capital expenditure will go in from big technology companies in the US. And that was, I think, before that came out in November. So that was before the Stargate AI announcement, 300 billion in capital expenditure for 2025. So that's a lot. Like, that's not going to come online, Elliot, for natural gas demand for by the end of 2025, but that's looking good for 2026, 27, 28, 29.
Right, exactly. And as I said, I mean, I think the 2025, there's going to be a huge growth in demand because of these new liquefied natural gas facilities, export facilities we have coming on stream. And I think that the AI story is extremely important. And I think it's one that will be with us for some time to come. Because as you said, all this new capital investment, all this growth and demand from these data centers, it's in the pipeline and it'll probably be in the pipeline for many years to come. The LNG story is maybe more imminent, I would say. And that is that, in 2022, there was a lot of talk about, interruption of Russian supply to Europe. And Europe, I think there was even some sort of joint statement between the Biden administration and the European leaders about importing more liquefied natural gas from the United States. The only problem with that is that, U.S. capacity to export liquefied natural gas is fixed. These plants take years to permit, site, build, right? They're prone to delays. One of the biggest in the United States that's been under construction is it's operated by Exxon, but it is actually in partnership with Qatargas, which is a national oil company, and it's called the Golden Pass LNG facility, and it was originally supposed to come on stream, I think, late last year or early this year, and it's been delayed until the end of this year because they actually had one of the major contractors on that facility, went bankrupt last May. So they sort of had to scramble to find somebody to do it. It caused months of delay, and that is a huge company with easy access to capital managing that deal. That's Exxon. So these things are subject to delays, and they take years to go through the approval, permitting, and construction process. So just because you might want to, you can't immediately increase liquefied natural gas exports. It takes time. So the price of natural gas got very extended in 2022. And, one of the things that we were writing about was the idea that there's going to be some demand pull from LNG exports is ridiculous because, the export facilities are already operating at essentially full capacity. And so since that time,
is Freeport back online? So you said full capacity. Does that mean the Freeport one, which that was a large one and that was mostly offline for the last year and a half? Is that one fully back online?
It went down. There was a fire at Freeport back in June of 2022, and it started coming back up online in 2023, and it is fully operational again at full capacity. But even with that, we're limited to about 12.5 billion cubic feet of natural gas exports a day in the form of LNG, or we have been up until very, very recently. In December of last year, there was a plant that came on stream. Another one came on stream in January this month. It came in service. And then we have between the end of last year and the beginning of 2026, we have 4 billion cubic feet a day of new liquefied natural gas export facilities capacity coming on stream. So we were at about 12 and a half a day prior to that, and we have an extra 4 billion cubic feet a day coming. That's 30% plus growth in export capacity in just over 1 year's time. And it's happening right now.
Is a lot of that because of the hot new IPO, the initial public offering that's going to be out soon? That's Venture Global LNG, or are they not a big player?
Well, they are. They do own. A stake in the Calcasieu Pass facility, which is an operating facility. They have new capacity coming on stream. So yeah, they're certainly a player. There are several. there are several players in some of these projects. As I said, the Golden Pass is one of them. That's a joint venture between Exxon and Qatar Energy, Qatar Gas. So there are a number of different
I
players
think
in terms of
Cheniere has
development.
it. Doesn't Cheniere have another expansion project too in the works?
Yes, there are multiple projects. And Cheniere has one. You have the Golden Pass facility. You have Plaquemine is another one that's coming on stream this year. These projects have been in the works for years. I mean, most of them were permitted 2019, 2020. So even long before the Russia-Ukraine conflict got started up, even before there was any inkling of, large scale disruption of Russian gas supply to Europe. But the point is that they take all that time just to construct, permit, build, all that. And they're just now coming on stream. And I can tell you they're going to be pretty full. I mean, we're already seeing some evidence of demand pull from these LNG facilities because what happens, they come in service and the operator immediately starts pulling feed gas to test the facility, make sure everything's working right, right? And then over time, they gradually sort of ramp up the amount of gas they're processing until they get up to that commercial LNG cargo rate. And so, what you're going to see is, like, for example, that plant that went on stream at the end of last year, by this spring sometime, it's going to be pushing out, full capacity cargoes. The plants that are coming on stream in this month or next month, by this summer, they're going to be pushing out these new cargoes. And so as these plants come on stream, a lot of them already have contracts to supply places like Europe, also Asian buyers. You're going to see a significant pull on U.S. natural gas supply. As I said, everybody's been talking about LNG for years, but our actual ability to export it was limited. We have 12.5 billion cubic feet of capacity, but by this year we're adding another 4 billion cubic feet. Next year, I think it's around 1.4 billion cubic feet. In 2027, it's another 3+ billion cubic feet. So between now and the end of this decade, U.S. LNG export capacity is going to grow by 85%. So, gas is I think 2025 is going to end up being the year of natural gas. I mean, that's what we're calling it in my service, because you have these multiple sources of demand growth, export demand from these new LNG terminals, as we talked about, this steady drumbeat of growth from AI, from data centers, and of course, electrification of nearly everything in the United States. You've also got demand growth from emerging markets for gas, right? India, China, very rapid growth in demand for natural gas and electricity and energy of all forms. So you have this great demand story for the U.S. natural gas, and I think that you're already seeing it in the price curve. You're already seeing companies lock in gas prices above $4 a million BTUs for early next year. Remember last year we had, on the front month, we had multi-year lows under 2. So, you have a much healthier gas price next year. And, I look at a lot of the producers that we cover here in the United States, at sub $2 a million BTUs, only the very most efficient producers in the lowest cost plays in the United States, a name like EQT, for example, can make money at $2 gas. But when you talk about 4, you're talking about almost every major shale play in the United States is profitable. And some of these companies are going to show tremendous growth in free cash flow because they're going to actually be able to ramp up production to meet this growing demand from places like the Haynesville Shale of Louisiana. So I think there's a lot of opportunity. Most of these stocks are really pricing in, maybe they're pricing in, by my calculations, for $3 gas. But when you start seeing, $3.75, $4 steady gas prices on average over the course of a year, these companies are going to be producing enough free cash flow that I think you have, 40, 50% upside over the next year for a lot of these quality stocks. I mean, EQT is one name we like. Another one is Expand Energy. Symbol is EXE. They used to be called, it's the company formerly known as Chesapeake Energy. And they're the largest gas producer in the United States. They have operations in the Marcellus Shale of Appalachia, which is a low-cost play. They also have operations in the Haynesville Shale, which is located right there in Louisiana, very close to all these new export facilities. Um, and their production costs in the Haynesville are a little higher. They're probably around $3 a million BTUs to produce free cash flow. But at 375 or 4, they're actually in a position where they can grow production into a very profitable gas price environment. And I could certainly conceive of gas prices going even higher than 4. If
So
demand,
you think that the demand driver will be liquefied natural gas exports to Asia and Europe, but that the natural gas producers in either the Marcellus and Utica Shale or the Haynesville Shale, which is next to the liquefied natural gas terminals, will be the beneficiaries?
yeah, I think that you have, in the US, you're going to have the two big demand drivers that we've seen for some time now are the LNG story, which, as I said, it's really hitting its stride this year. But yeah, as you said, the AI story as well. EQT, for example, they made an acquisition of a company called Equitrans, right, which is a midstream operator, and so they owned pipelines, they owned gas processing and gathering facilities, and they also owned the largest stake in the Mountain Valley Pipeline. And the Mountain Valley Pipeline, or MVP as we call it, was a pipeline from the Marcellus Shale that moves through parts of Virginia and interconnects with another major pipeline that goes up and down the East Coast. And the Mountain Valley Pipeline was tied up for years in environmental opposition. And a lot of people thought it wasn't going to get built. But the very last minute, as part of a deal with Joe Manchin, the senator from West Virginia, the government green-lighted the project and they completed it. And the beauty of that pipeline, now it's part of EQT because they acquired Equitrans, is that it gives them access to all the data center construction that's going on in places like Northern Virginia, right? So
Yep.
all this new capacity, all up around the DC area, Northern Virginia. Um, um,
And this is the
my
data
old
center
haunting,
capital. Yeah.
the data center capital, my old haunting grounds. I believe you live up in that area now, right?
Yep.
It's So they can actually interconnect by a Mountain Valley pipeline and go up and down the East Coast and supply all the power needs there. I mean, the electricity demand in Northern Virginia, DC area is growing even faster than the nation as a whole. So, I think that operators in Appalachia, the traditional disadvantage they have when it comes to LNG is getting the gas from the Marcellus Shale all the way down to the Gulf Coast. But
You don't need to
certainly,
do that. We just need to get it like one state over then. It's a lot
right,
shorter. Yeah.
it's a lot easier to do if you're just moving it via a pipeline from,
Dominion
say,
may even
Pennsylvania.
the Dominion Electric Utility may even pay for part of it. The electrical utility company. There might even be like a joint venture between EQT and the Virginia Electrical Utility Company, Dominion Energy.
Dominion,
Maybe.
yeah, certainly they're going to benefit from that. The state gets a ton of electric power from natural gas, of course. Yeah, certainly they're going to benefit from that. And I think that um, the Marcellus Shale, the Utica Shale, being such low cost plays, are a natural supplier of electrical power and power for these data centers to that area of the United States. Now, that doesn't mean that gas won't make its way to the Gulf Coast for LNG. Of course it will. But some of it's going to end up, just powering the growth we're seeing in AI and all that, the whole high tech industry, right, in Northern Virginia and that area. So, there are a lot of growth drivers. I mean, I love seeing an industry that's got multiple growth drivers. You're not just relying on one source of demand growth. I mean, there's multiple things, and they're all kind of converging on the next few years.
Yeah,
In
I'm just
particular.
I totally agree. I mean, I just pulled up the headlines for Trump and LNG, and it says the Japanese government is looking at a $44 billion deal to invest in Alaska LNG pipeline. I mean, Canada's getting involved in this. They just set up a pipeline there from Alberta to the west coast there for British Columbia, and they have a liquefied natural gas export facility coming online. So it looks like this could be like one of the biggest natural gas booms over the next like 5 to 10 years, as long as like Democrats, if they regain Congress at the next election, or Democrat in the White House 4 to 8 years later, they don't shut this thing down. It looks like natural gas is going to have a huge boom for
No,
demand.
absolutely. And you mentioned Canada, and I think Canada is kind of an overlooked story as well. There's in western part of Canada, they're building a new LNG terminal called LNG Canada. Very, very creative there, naming wise. But right,
Yeah, Justin Trudeau named it.
right there you go. And the capacity of that one facility is a little over 2 billion cubic feet of natural gas exports a day, and it's coming online this year. Now, I think that it's supposed to come online around the middle of this year. And so most of the demand from it will start to hit the market sort of later this year in the second half. But there are also two smaller projects in the works there. So it's going to take the total new export capacity by sometime next year, 2026, I mean, up to around 2.5 billion cubic feet of additional LNG export capacity out of Western Canada. And the whole of Western Canada only produces about 18 billion cubic feet of natural gas a day. So you're talking about an area that produces 18, 19 billion cubic feet a day and an incremental 2.5 billion cubic feet a day of demand. I mean, that's huge. The problem up there is there's a huge natural gas play called the Montney Shale. And a company that we like that is a player there is called Ovintiv. The symbol is OVV. They have acreage in fact, they just made an acquisition in that area of additional acreage in the Montney Shale. It's a very low cost oil and gas play, but it does produce an awful lot of natural gas. However, that area of Canada has been oversupplied with gas. And in fact, you've had a lot of producers in that region that have been kind of ramping up production in anticipation of this new LNG export terminal. So gas prices have been really low because they've been producing all this gas. There's not enough market for it. And so a lot of it's ended up in storage in the northwestern US and Canada, in Western Canada. And the price has been really depressed up there. But as you have this new LNG terminal starting to pull gas out of that area, suddenly the price, and it's been trading at a huge discount to gas, say at Henry Hub. I think one of the things that people don't realize about the US natural gas market is it's a little different. This is true to an extent in oil, but less so. It doesn't only matter, how much gas you produce, it matters where you produce it, right? Devon Energy, I'm sure you've probably heard of that company. It's one of the larger oil and gas producers in the US. They produce a lot of gas in the Permian Basin of West Texas. And in the most recent quarter that they reported, which was Q3 of last year, they were getting the price of natural gas in their market after hedges rather, was like 81 cents. 81 cents a million BTUs.
Ew, no one can make money at that, yeah.
No, and over on the Gulf Coast, it was over two anyway. It was still very low, but it was over $2 a million BTUs. So there's this huge discount because there's no way to get that gas to the Gulf Coast because there was not enough pipeline capacity to move it. But in Canada, right, it's been at times even more depressed than in the Permian Basin of Texas. So now suddenly you're going to have this new pull of demand, LNG Canada, which is going to help close that gap. So they're going to start getting better pricing. So, I think that's a huge opportunity as well. And that 2.5 billion cubic feet a day figure from LNG Canada, that's not included in the 4 billion cubic feet I'm talking about. That's only from the United States. So Canada's another whole story. And then Mexico's another story. So in Mexico, they're building LNG export terminals, partly to take U.S. gas and export it from Mexico because it was easier to get, permitting for a project there than here in the U.S. So that's another source of demand pull. If you include all those, I mean, by the end of 2030 or so, you could see North American, by which I mean, Mexico, the United States, and Canada, LNG export capacity, topping, 25, 26 billion cubic feet a day, which going from 12 and a half to 25, by my math, that's, sort of 100% growth, a doubling in capacity over a relatively short period of time.
I've seen like in the 30s though. So I've seen more than a 2x projection. So I guess it just depends on which estimates you look at, but conservatively it's potentially could double by what early 2030s. I mean, there's a lot of
Yeah,
growth opportunities there just from Asia and Europe diversifying away from Russian supply. You add in data centers. I mean, you mentioned that natural gas that's trapped in the Permian Basin that's cheap. Why not? And we're starting to see announcements of this with the data center, with the technology companies. They're announcing data centers in Texas. So they're
right.
starting to build data centers in Florida. They're starting to build data centers in Mississippi and Texas. It's for access to that cheap natural gas. It doesn't all have to go to the liquefied natural gas export facility. You can build a data center with a pipeline not too far from there.
No, right. And it makes sense to try to locate them in areas where, where there's a lot of local supply and not a lot of local demand. So it totally makes sense to cite things, for example, in West Texas, where, not that many people live there. So the local energy demand is relatively low, but at the same time, you have this tremendous supply. And, a lot of that Permian gas supply is what we call associated gas. So these producers they're not drilling for gas, they're drilling for oil, but the gas is kind of a byproduct. So traditionally, a lot of places, they were just burning it off. They were just flaring the gas. But,
Well, that's like
now,
illegal now. Yeah, they have like
right.
satellites. So I heard the Biden administration had literally like heat sensor satellites monitoring that, and they were like issuing real time fines. So
Right. And so, it's illegal. Obviously, it's kind of wasteful of a resource, right? Also. But, imagine if you could use that gas instead of selling that gas for literally at times negative pricing. There were several months last year where we saw the price of gas in the Permian Basin area negative. You had to pay someone to take the gas off your hands. So imagine instead of selling gas for next to nothing or less than nothing, right? You could, actually use it for something, like a data center to power a data center that, that's is useful. You're making use of a resource that you can actually get some value out of. So yeah, I mean, it makes a ton of sense, and the U.S. is the world's largest gas producer. A lot of these producers that we like, I like to look for companies that have 15 or 20 years of reliable inventory to grow production or to at least maintain their current rate of production. And I generally tend to favor companies that have some sort of a near-term catalyst. I mean, EQT, I mentioned that Equitrans um, pipeline or midstream buy that they made. The cool
it,
thing about that is, most of these Marcellus producers can't really grow their production much because their amount of pipeline capacity they have to handle it is limited. But with EQT, now that they own Equitrans, they actually have the potential to grow their production a little bit um, on this new Mountain Valley pipeline. Just getting control of that, getting control of all their midstream infrastructure, it lowers their costs and it gives them the ability to actually grow production.
isn't the
Um,
EQT stock, wasn't it up like 60 or 70% in the last like 10 or 11 months already, or did it have a correction on this deep seek sell off?
it did have a correction on the deep seek sell-off. What's interesting, the market started to, at the end of last year, started to price in a little bit more with EQT. I remember for months and months and months, that stock was depressed. I mean, it was down in the 30s, low 40s. And, gas prices were low. The stock was cheap, really cheap. Then late last year and early this year, we saw a big pop in EQT stock. It got up into the low to mid 50s. And it did pull back. It was down almost 10% on the Monday when that deep seek news kind of hit the wires. I think it hit the wires like after the market close or right around the market close on
Yeah.
Friday.
Yeah.
And EQT got hit on Monday. I think one of the reasons for that is, EQT, the management team has been very vocal
Outspoken.
about the growth potential of AI. And so, I think that what you have is you have a lot of general fund managers, kind of hot money, if you will, that was looking for alternatives to like NVIDIA to play the AI boom, to play the whole artificial
Yeah.
intelligence narrative. And so they piled into EQT and Cameco and all these stocks that you wouldn't think necessarily have that much to do with AI. And the DeepSeek news initially kind of shocked them, but this EQT has made back most of those that dip already, and I think it's worth in a $3.75 to $4 steady state gas environment. I think that stock is worth probably $75 a share. It's in the low to mid 50s now. And that's just based on the free cash flow that they can generate from gas prices in that 375 region, the potential to grow their production because of this Equitrans acquisition, and the fact that because they've vertically integrated with Equitrans. In other words, they were traditionally an upstream company. Now they own the whole midstream transport infrastructure. They're actually squeezing a lot of cost out of their production model, which was already one of the cheapest in the U.S. So if you exclude the interest on their debt, which they're paying down, right, with cash flow because they took on debt to buy Equitrans, they assumed Equitrans debt. Their unlevered break even is like $2 a million BTUs already, and by the next couple of years, they're going to squeeze even more cost out. I mean, I think they're going to be down in that 180 region, which is incredible. They can produce gas profitably at $1.80 a million BTUs. That's just incredible. And so, I think that's a nice catalyst for them.
So it sounds like it sounds like a buying opportunity if you think that this DeepSeek news that the market had a dramatic overreaction. And I don't know if the correction's done with that, but I mean, I've been speaking to hedge fund managers, tech experts. I have a friend who has multiple Harvard degrees in both like quant for math, and also like was doing artificial intelligence research at Harvard, and she's a hedge fund manager. And she was telling me that like the whole DeepSeek stuff, there's no way that China could have even done. We don't have time to discuss the whole thing, but there's no way China could have done all this stuff without NVIDIA chips. It sounds like they bought over 50,000 NVIDIA chips out of Singapore. Sounds like the Chinese government, Chinese military spent way over $50 million, which is the claim for that. So, and then the artificial intelligence with the learning language model innovations that DeepSeek did, they were integrated by Microsoft and Perplexity AI, American companies that don't scrape your emails. All those innovations were added in a couple days. So the market like had a dramatic, huge overreaction that like this new artificial intelligence algorithm, we're not going to need to use electricity and power. I think it's drastically overblown. I don't know if all the data centers need NVIDIA chips, but I know they're going to need electricity, Elliot. I know they're going to need reliable. These new data centers are getting built. Meta's still committed to the CapEx. They just announced an increase. Amazon is planning on increasing. Microsoft is still planning on, I haven't seen any announcements saying they're going to cut the 80 billion in CapEx. Google is still spending. So until we see announcements that they're going to stop spending on the data centers, I'm seeing the opposite actually.
No, right. I mean, it's kind of an arms race too, right? So you have all these companies trying to get ahead on it, and they're trying to, evolve faster than their competitors. And, if anything, I mean, I think the DeepSeek news could prompt some more spending from your U.S. companies who want to make sure that they're even farther ahead of China.
Have you looked up Jevons? Have you heard of Jevons paradox? I actually
I just wrote about that in the last issue. The idea being that when you make something when you can produce something more efficiently. This was actually the idea was actually invented in the 19th century by this guy William Stanley Jevons, and I think he published a paper on it in 1865, and a lot of the early examples of it were in the steel industry, right? So the efficiency of producing steel, they improved the efficiency of producing steel, lowered the cost of producing steel so much in the late 19th century that they reduce the energy inputs needed. They reduce the raw material cost of producing steel. But what happened? Everybody went out and found new use cases for steel. So you had all these skyscrapers being built.
So
Because
supply
steel,
increased, but demand increased more. Is that what you're saying? Because
exactly. You have a technological advancement that makes something more efficient and cheaper. They call it a paradox, but it makes sense, right? People go
well,
out and
it is
come up
kind
with
of
more reasons.
counterintuitive because if the artificial intelligence software companies are not going to make money, let's say this innovation with DeepSeek, these other software companies become open source, the leaders change every couple months. Whoever is leading the artificial intelligence software algorithms, we switch from learning language models to AI agents in 2025, 2026. I mean, that's going to be more use cases for more people on their phones, more people, more
Right.
businesses, more small businesses using artificial intelligence software. The switch is, I think the market doesn't understand this, switching from regular search. So switching from like Google or Mozilla Firefox, a regular internet search browser, to switching to a AI prompt, one of those, and that uses way more power. So that switch, if that technology is cheaper, people will switch even faster and more on their phones and on their computers and at their businesses.
Exactly. They'll just
Yes.
use it more.
And that means, yes. So that means more demand, and then that means more electricity demand long term.
I saw a stat, and I can't remember where I read it from. It might have been my colleague Roger actually, but a standard Google search versus an AI powered Google search. The AI powered search takes 300 to 400% more electricity. So imagine multiplying that by people using it, across everything, their phones, their computers, of course. Um, the potential growth there is tremendous.
Well,
Just from that
OpenAI has
alone.
this. Did you see OpenAI has disclosed that their ChatGPT Pro, that's the one that people pay $200 a month. People love using it so much that they're actually losing money. For the people who are
Right.
paying $200 a month, it's being used so much by the people paying for the $200 a month Pro that OpenAI is not making a profit on it.
Well, and it makes sense that if it became cheaper because their costs went down, for example, more people would use it and find more uses for it. And that's Jevons paradox in a nutshell, right there. And I think you could. I mean, look, I'm no expert on AI for sure, but you can see the actual growth and demand already happening. You can see some of the estimates for future growth. And I don't think the deep sea, the initial reaction, in the markets, sometimes when a news is released, there's a knee jerk reaction because especially where you have a sector that is the subject of a lot of hot money or general investors who are looking for ways to play it, and they kind of all cram into a handful of stocks. And so I think you had a lot of people in Cameco and EQT and names like that who
And
saw the news
Nvidia,
and
yeah,
immediately.
there was people like leveraging up, yeah, with a ton of like margin debt with Nvidia and some of the other chip
Exactly.
companies, yeah.
And so when news comes out, some of those people bail, right? And so you get this drastic knee jerk reaction. But then, over time, people realize it's maybe not as big of a deal as they thought initially. And the narrative shifts and moves on to something else. And, the fact is that EQT is still going to benefit from increased electricity demand. And DeepSeek didn't change that. And it certainly didn't change LNG export demand, which is, as I said, a lot of it's already priced in under longer term contracts. And then you also have the fact that, a lot of that growth and demand outside the United States has nothing necessarily to do with AI data centers. It has to do with the fact that Europe is going to lose all of its manufacturing capacity if they can't get a reliable source of baseload energy, right? And people are literally going to freeze to death in a cold winter.
Well,
Which
they just need to diversify their natural gas supply away from Russia. I mean, so that's
Right.
just like,
And then you've got places like India where the growth is also from basic electrification. People don't have access to electricity, and suddenly, as the economy grows and becomes wealthier, more and more people sort of enter the ranks of the middle class. Right, that story. So yeah, I just think there's multiple sources of demand growth, and a company that can produce gas profitably at a low cost is going to benefit from that. And even though they've moved up a lot from where they were, in my mind, they're still not pricing in 375 or $4 natural gas over the long haul. Expand Energy, that company, by my estimates, could be producing, at $3.75 gas, they could be producing upwards of $2.5–3 billion a year in free cash flow. With that level of cash flow, I could see the stock getting up to around that 150 area from, a little over 100 today. And again, the catalyst there, they made an acquisition last year, Southwestern Energy. They closed in October. They published sort of an early estimate of their costs for this year, sort of an early guidance for 2025. And they already identified, a lot more acquisition synergies, cost reduction opportunities. They also have, when prices were low, natural gas prices were low last year, they cut their capital spending, and they also didn't turn on certain wells. We call it a turn-in line. It's the final stage of putting a well into production. And so they have this sort of gas in reserve, which they can bring into production relatively quickly and with minimal capex when prices improve. So I think there's a lot of catalysts and individual producers, particularly, to benefit from this upside in gas prices and all this new demand we're talking about.
Well, I've kept you for over 90 minutes, Elliot. I'm kind of getting like a migraine here talking so much. It's so much overwhelming. It's a fire hose of information here of an energy discussion because we integrated data centers and artificial intelligence, liquefied natural gas. I don't know if natural gas has had this much of a demand side growth picture in a very, very long time. These are two really big trends with the liquefied natural gas exports from the U.S. with the cheap natural gas that can be exported. They want to appease Trump. These other countries want to diversify away from Russia, and then the data centers. I do not see, personally, this is my opinion, I've done a lot of research on this, I do not see the data centers going away. I mean, the only thing that would really change my mind is if you see like the technology companies come out and announce they're slashing the capital expenditure budgets, and I'm actually seeing the opposite with the Meta announcements with their earnings, because they had a really good earnings 10 days ago, and then they announced they're going to spend even more on data centers. And for our listeners out there, they actually have a very large competing open source artificial intelligence software called Llama, which will probably integrate the best parts of DeepSeek soon if they haven't already done so.
Right. I mean, that's the thing. I mean, it was an open source situation, so they can instantly sort of add that to their own system.
Yep, and Meta can subsidize their research and development, their capital expenditure with the profits from advertising on Instagram and some of their other profitable businesses. They can take that and invest into growth. And even if the artificial intelligence software companies, even some of them fail, the chip companies have problems, I still see electricity and the infrastructure to build out the data centers, the electricity, because I see a lot of businesses, a lot of adults on their phones just switching from regular search over to the more electricity intensive artificial intelligence programs.
Absolutely. I think it's a compelling growth option. And, as you said, we haven't seen this level of electricity growth in a long time. As I said, we haven't seen the U.S. electricity demand grow at this pace since the 50s and 60s, which was the suburbanization of America, basically. That's incredible. I wouldn't have necessarily said, 5 or 6 years ago that the sector I cover most closely, energy, would be, at the center of the technology revolution. But it's very much the case. I mean, the fact is that you can't run AI, you can't run data centers. Technology doesn't work without energy. And,
without cheap natural gas and nuclear. Those are the two most safest, reliable bets to power all this. And I mean, I've had trolls just say that like, I use ChatGPT on my phone. That's the front end. So they notice like, I don't notice any big difference on my electricity or power bill on my phone, switching from ChatGPT, switching from a regular internet browser search to ChatGPT, all that stuff, the electricity demands all on the back end with the data centers and how much electricity is required to power the learning language models, the other artificial intelligence programs, artificial intelligence agents are coming online. The average person, when they're, running ChatGPT on their laptop or their desktop or their phones, they're not going to notice what's really happening like on the back end with the data centers.
No, absolutely. Yeah, that's just yeah, exactly. That's just the interface. It's not the core of the power.
Yeah, I mean, speak to the tech companies and the professionals. They're like, we need all this. That's why you have like Microsoft and Amazon. They paid, I think, 80% above the spot prices. Rick Roll said this, the uranium expert, commodities and uranium experts. He said that the tech companies paid 80% above the market price to lock in the nuclear power that was available already. So, I mean, like, if they're willing to pay that, they know that they need the reliability. And I think the next one is natural gas, where all this, the pipelines and like I think Chevron and Exxon Mobil have a chance here to make some huge investments into these data centers.
Yeah, absolutely. I agree.
Well, I want to thank you so much for your time. We spoke for way over 90 minutes here. It is a very long time, starting to get a sore throat and a migraine.
Well, we always have a good conversation about energy when I'm on the show, and it's always a pleasure to be on.
Yeah, our energy discussions receive a lot of positive feedback. I mean, I think someone said that they're some of the best ones on all financial YouTube. So keep up the great work, Elliot, and definitely like we'll have you and Roger Conrad because Roger covers these electrical utilities and the data centers. We'll have both of you on every couple of months for sure.
Look forward to it. Thanks again.